Hello guys and welcome back to my channel. It's probably one of the most favorite stages of the market. That's what I like. I enjoy seeing the redness all across the board. This is 1 month performance, and as you can see, there was almost no places to hide except the energy sector, which was quite booming, and also few more green spots, and other players are quite red. And if we check the S&P 500, it finished on Friday at the lowest point here, so it went down about 9% from all-time high, which was just 2 months ago. Also, if we check Nasdaq, it's I think it went down about 12%. Yeah, my experience shows actually that this is the time of the best opportunities. And also, let's see what the fear and greed index shows. It indicates now extreme fear in the market, has indicator at 10. And how to read this indicator? So the fear and greed index is used to gauge the mood of the market. Many investors are emotional and reactionary, and fear and greed sentiment indicators can alert investors to their own emotions and biases that can influence their decisions. When combined with fundamentals and other analytical tools, the index can be a helpful way to assess market sentiment. Also, there is another nice index to see how the market reacts to the circumstances, the so-called volatility index, which is VIX, and now it finished the week above 30. You can see the recent highs were during the so-called Liberation Day, when it jumped at some point to 60. So what does it actually mean? The index, often called the fear gauge, measures the stock market's expectations of the volatility over the next 30 days. It's derived from the prices of S&P 500 index options. And let's have a look on this table. So now we are above 30. And at this point, the market sentiment is described to be as high fear or panic. I think S is just on the edge, just above 30, so it's a high fear one. So it means that it's a significant market turbulence, often coincides with major news events, crashes or recessions. So one more index that indicates extreme fear in the market. And also, if you watch some CNBC news, some Wall Street journalist interviews, you can clearly hear cautious tone, and the rhetoric is more like being on the safe side now. So there is definitely risk of sentiment. Always, in these kind of stages of the market, I remember, and I think the majority of people who are involved in investing, and especially in stock market, they remember the classic phrases from Warren Buffett. And also I've got two references, the Warren Buffett and Peter Lynch. And what do they recommend, or what do they say during these kind of market conditions? Let's start with Warren Buffett. Be fearful when others are greedy, and greedy when others are fearful. Buffett's cornerstone advice suggests that when widespread panic sets in, bargains appear, making it the ideal time to buy. Bad news is an investor's best friend. He believes that market chaos all allows for buying a slice of America's future at a market down price. Then keep calm and cash ready. Buffett advises against panic selling and often maintains high cash reserves to deploy when markets collapse, arguing that fear is a friend to the fundamentalist. It's worth mentioning that he speaks about the fundamentally strong companies. Obviously, the trash stocks now are hit really hard. Then prepare for volatility. He suggests investors must be comfortable with stocks dropping 50% or more, provided they are comfortable with the business they own. Yeah, if we come back to the Nasdaq, for example, it's it's already a nice correction. It's 12% being down from the all-time high, but it doesn't mean that it cannot get lower, because even if we have a look on the Liberation Day, which happened in March-April last year, the index went down 26%, and this was the situation when the market was dependent on basically one person only. There were no two sides. Now the circumstances are different. Then let's have a look at the Lynch perspective. What he says: don't panic, sell. Lynch famously said the real key to making money in stocks is not to get scared out of them, emphasizing that investors must tolerate declines to enjoy long-term gains. The stomach, not the brain. So he argued that market success depends on controlling emotions, stating that far more money has been lost by investors preparing for corrections than has been lost in the corrections themselves. Correction equals opportunity. Lynch viewed market corrections as a wonderful opportunity to buy your favorite companies at a bargain price. Basically says the same as Mr. Buffett. Focus on fundamentals. If you know what you own, that is, you understand the company's financial health, you should feel confident buying more when prices fall without justification. And a bit of conclusion here. Both experts agree that markets will always be scary and that trying to time the market is a fool's errand, with long-term patience being rewarded over short-term panic. And speaking about Lynch, I do strongly recommend to read this book, One Up on Wall Street. It's a great book for those who just started investing in stocks or has been investing for quite some time. It's always good to remind yourself the fundamentals of the process itself. And why is it even worth listening to the people like me, for example, who is not a professional or institutional investor? That's what he says, by the way, here. Rule number one in my book is stop listening to professionals. 20 years in this business convinces me that any normal person using the customary 3% of the brain can pick the stocks just as well, if not better, than the average Wall Street expert. And here he adds, in fact, the amateur investor has numerous built-in advantages that, if exploited, should result in his or her outperforming the experts and also the market in general. Moreover, when you pick your own stocks, you ought to outperform the experts. Otherwise, why bother? So it's definitely a nice book to read. There is well explained how to evaluate the stocks, different ones, cyclical, growth, value, dividend ones, when to buy, when to sell, and it's quite easy to read, I think, for everyone. So guys, what's my conclusion is, I suggest you not to panic in these conditions. There is a lot of news which make us to start being fearful, and many people would think to sell their stocks and maybe to buy later. But I would not do this, and obviously the market can go even lower. We don't know where the bottom is, but the prices for the majority of the fundamentally strong companies are already so good that I would rather use this advantage to add to the portfolio rather than being selling at this time. Alright guys, thanks for watching this video, and I hope you'll hit the like button and subscribe to my channel, and I'll see you in the next video. Goodbye.